All right, let's talk about your money and what's changing in 2026. Canada's tax landscape is getting a bit of a shakeup, and trust me, it's going to hit your wallet directly. We're seeing some key numbers go up and others are coming down. So, over the next few minutes, we're going to break down exactly what this means for your savings and, maybe most importantly, your take-home pay.
Really, it all boils down to this one big question, doesn't it? By the time we're done here, you're going to know exactly how all these changes stack up and whether you'll actually see more cash in your pocket. So, let's just dive right into the numbers.
Okay, so here's how we're going to tackle this. We've broken it all down into two simple buckets. The good news, which, is all about tax cuts and more room to grow your wealth, and then there's the bad news, which really just focuses on one key deduction that's going up. Let's kick things off with the good stuff.
All right, first up in the good news department, the government is giving us all more room to save in our most powerful accounts. And honestly, this is a huge deal. It's a massive opportunity for you to build your wealth even faster. So, let's start with the TFSA, the tax-free savings account. You're getting an extra $7,000 in contribution room. And the best part? This applies to everyone who's 18 or older with a social insurance number. It doesn't matter what your income is. And hey, if you can't use it all right away, no worries. That room just carries forward, waiting for you.
So you're probably wondering, okay, how much room do I have in total? Well, this table gives you a pretty good idea. If you were born back in 1991 or even earlier, and you've been here since the TFSA began, you'll have a massive $109,000 in total space. Wow! Now, if you're just turning 18 in 2026, you get to start with your first $7,000. And for anyone new to Canada, your room starts building up from the year you get here, as long as you're 18.
Okay, let's switch gears to the RRSP, the Registered Retirement Savings Plan. Now, your personal limit is always that 18% of what you earned last year. But the maximum you can contribute in a year is getting a bump up to $33,810. Now, it's super important to note, this higher cap, it's really for high-income earners. You'd need to be making over $180,000 to even hit this limit. For most of us, that 18% rule is still what's going to set our personal max.
Okay, if buying your first home is even remotely on your radar, you need to listen to this next part. It is absolutely critical. We're talking about the First Home Savings Account, or FHSA. And this thing is a powerhouse. Seriously, it's like they took the best parts of an RRSP and a TFSA and smashed them together. You get a tax deduction when you put money in, just like an RRSP, but then your withdrawals for a home are totally tax-free, just like a TFSA. It's the best of both worlds.
But there is a critical deadline and a really powerful strategy you need to know about. Here's how it works. You get $8,000 of room each year, but only once the account is open. So if you open an FHSA before December 31st, even if you put $0 in it, you lock in that $8,000 of room from 2025. It carries over. Then, come 2026, you get another $8,000, giving you a grand total of $16,000 in room. If you wait until the new year, you just lose that first year's room forever. So don't wait.
All right, and the good news just keeps on coming. So beyond just having more places to put your money, you're actually going to be paying less federal income tax. Let's break down how that's going to work. So as you know, for a long time, the tax rate on that first chunk of your income has been 15%. This is the base rate, the one that affects literally every single person who pays taxes in Canada.
Well, for 2026,
That rate is dropping down to 14%. That is a full 1% cut on the first $58,523 you earn. Now, I know 1% might not sound like a game changer, but it's a tax cut that literally everyone who pays tax gets to benefit from.
And that's not even all of it. The tax brackets themselves are getting wider. They're expanding by 2% to keep up with inflation. What that really means for you is that more of your money stays in the lower tax brackets, which is great. Plus, the basic personal amount is getting a nice boost. This is the magic number. It's the amount you can earn before you pay a single dime of federal tax. And in 2026, that number is going up to $16,452.
And to top off all the good news, this one is huge, especially for investors and business owners. Remember that really controversial proposal to increase the capital gains tax? Well, you can forget about it. It's been completely scrapped. It's officially not happening.
Okay, so we've gone through all the good stuff. Now it's time to look at the one item on the other side of the ledger, an increase to your Canada Pension Plan deductions, also known as CPP.
Now, before you start to worry, it is so important to think about this the right way.
This is not a tax. It's not money that just vanishes into general government spending. Every single extra dollar you put into CPP goes directly toward boosting the pension you will get paid every single month when you retire. Honestly, the best way to think about it is as a forced savings plan for your future self.
So what does this actually mean in terms of dollars and cents? Well, for higher income folks, we're talking about people making over about $85,000 a year, the maximum you'll contribute is going up by $216 for the whole year. And here's the key part. If you earn less than about $71,000, this change won't affect you at all.
And let's put that number into perspective, because $216 a year can sound like a lot. But when you break it down, it works out to about $8 extra coming off your biweekly paycheck. And that's only if you're in that highest income group. For most people, it's going to be less than that, or even nothing at all.
Okay, so we've looked at the good news, we've looked at the not so bad news. Let's bring it all together and finally answer that big question from the start. What is the bottom line for your wallet?
So let's just recap real quick. We've got more room to save and invest completely tax-free. We've got lower federal income taxes for everyone. On the flip side, some higher earners are going to be putting a little bit more towards their own future pension. So when you do the math, for the vast majority of Canadians, the tax cuts are going to more than cover that small CPP increase. The net result? Yeah, it should be more money in your paycheck.
So there you have it. The big tax changes for 2026 are, when you look at the whole picture, a net positive for most people. Which really just leaves one last question, and this one's for you to think about. Now that you know all this, what are you going to do about it? How are you going to adjust your financial plan for 2026? Are you going to pump up those TFSA contributions? Are you going to use that slick FHSA trick we talked about? It's your money, after all, and now you know exactly how to make the most of it.